So understandably, a lot of people have been worried about their money recently in light of what's been happening to some banks outside of the UK. We obviously had Silicon Valley Bank go bust in America. We had Credit Suisse go bust in Europe. Yes, they've been rescued. Yes, there have been situations that gone on, so those banks have carried on okay. But it does make people think about, well, what's going on here? Is there a bigger banking crisis going on? If there was to be, could it be like back in 2008? Could there be runs on my bank here in the UK? Could it mean that my bank goes under, my bank is gone? And if that was to happen, what happens to my cash? So this is what this video is going to talk about. It's going to talk about something called the Financial Services Compensation Scheme, aka FSCS. I sometimes get that mixed up a little bit, but it's FSCS, okay? And this is something which, as long as we'll go through in this video, as long as your bank, your building society, your credit union, whatever it is, as long as it is part of that, then you should be okay. So broadly, what is this Financial Services Compensation Scheme? Well, this isn't set up by the government, set up by Parliament, but it's an industry-funded scheme that it covers a lot of things, right? We're focused on savings. It does also cover things like mortgages, funeral plans, investments, insurance, all that kind of stuff is also covered in different ways. We're focusing here just on savings. And if you were to, your bank, whatever it is covered by this, was to go under, they will just pay your money back up to some limits. And we'll come to those limits in a moment. In fact, you wouldn't have to do anything. They'd automatically refund you money. And they say this will happen within 2 to 3 days. So yes, it'll be stressful. Yes, it'll be problematic, but at least your money is going to be okay, right? So how much? What are these limits? Well, the main one, and you've probably heard this a few times, I've certainly spoken about it a lot on the channel in the past when taking you through the best savings accounts, which I do every single month here on the channel. The limit is £85,000 per financial institution. Now, 85k, for most of us, we're going to go, well, we're fine then, right? We're going to be no worry, problem at all. As long as you're in, and I'll come to how you can find out if your bank is covered in a minute, as long as it's in one of those places, no problem at all. If anything was to happen, and let's hope it doesn't, but if it was to happen, then you're going to be absolutely fine. But there might be situations where you do have more than 85k, maybe temporarily, or maybe just you have got larger amounts of savings. So there are some ways around it there to ensure you are covered as well. And let's first of all talk about temporary high balances. And this is for certain things, not everything. So you have to again check the whole list on the FSCS. I told you I get it mixed up. Sorry, FSCS website. Certain balances, temporary balances of up to £1 million will be covered for 6 months. And this is things like you've sold a property, you sold your home, but you haven't straight away bought a new place. Maybe there's a bit of a gap in between. Maybe you've got an inheritance that's come through that's quite sizable. Maybe some kind of payout from some sort of accident, whatever it might be. Maybe your pension, you've taken that 25% tax-free chunk at the beginning. It's a nice hefty amount. Those things, and they come into your account, protected for 6 months, up to £1 million. Okay, and that's plenty of time for you to buy the house you plan to buy potentially, or to move that money elsewhere into different accounts. Because I say this really key thing here is that I said before, it's £85,000 per financial institution, not per person. Okay, institution. So what this means is if you have more than 85k longer term, either that short-term stuff, you've got a lot, you can split it all out, or just broadly, longer term, you have more than 85k, you can put it into accounts at different banks. Now, there is one thing here you have to be very careful of. There's a few things we'll come to, but the main thing here is, it doesn't say, it says per financial institution, right? And this is basically institutions that have a banking license here in the UK. And most of them, it's one bank per license, okay? So it's pretty easy. But there will be a handful where it is shared. Now, sometimes banks operate under different brands, okay? Sometimes they have come from mergers. They've either taken over a bank or they've merged together or whatever it is. So there could be a number of different sub-brands, even if they're not publicly available anymore. You might have an old account somewhere, but you got consumed by a different bank. Now, there's a very, very useful link over on the Financial Services Compensation Scheme website where you can type in the name of the savings provider that you've got, and it will tell you whether that license is shared. But just a quick heads up, some of the key ones which you need to be aware of, the ones you might possibly be more likely to have money in, a couple of these. We have Cooperative Bank, which also has Smile and Britannia. We have Bank of Ireland, Post Office, and AA Financial Services. And these are ones more high street ones you might actually have money across more likely. Halifax and Bank of Scotland, they share a license along with Intelligent Finance and Birmingham Midshires. There's HSBC and First Direct. They are the same bank. They just have different brands within them. They operate separately day-to-day basis, but there's one license. Marcus and Saga. It's unlikely you've probably got both of those, but it's worth knowing about that. Santander and Kahoot. Again, not many people use Kahoot, but they do still offer savings providers. So you might have money in there and in Santander. And then Virgin Media, Clydesdale and Yorkshire Bank. They're the kind of the other big ones. Again, Clydesdale and Yorkshire Bank don't really operate anymore. And B was part of that as well. Really under the Yorkshire, so the Virgin Money brand now. But it's worth knowing about that and being sure that you do not have more than the £85,000 across those shared licenses. Because if you did, let's say you had £50,000 in HSBC and £50,000 in First Direct. And let's say HSBC went under, which is the key brands. If they went under, First Direct would also go under. Well, you'd only be covered up to £85,000. You would lose £15,000. So ideally, don't do that, okay? Put your money in different banks with different licenses and your money is covered. Now, I said about checking on the Financial Services Compensation Scheme website as to whether the place that holds your money is part of the scheme. And it is well worth doing this because you will be probably surprised that there are some that aren't. They might operate like a bank. You might think they're a bank. They are a bank. They are regulated here in the UK, but they don't have a full license. Some big names here, particularly some digital ones. So Revolut and Monese, they are not fully licensed, fully regulated UK banks, fully licensed banks. They are not part of the Financial Services Compensation Scheme. Savings providers like Chip, or Plum, they are not part, they do not have a banking license, so they are not directly part of Financial Services Compensation Scheme. Budgeting apps where like Hyperjar, again, they are not part of it. So there will be more, there are many more, but it's worth having a look. Now, just because you use these accounts, these banks, doesn't mean there aren't protections in place. Doesn't mean you shouldn't use them. It's just being fully aware of how they operate. And they do operate differently on a case-by-case basis. So I'm not going to go through all of them, but I'll give you a couple of examples. Something that some of them do, and Chip's a good example here. They have, at the time of recording this, a market-leading 3.4% instant access savings account. And that is top of the table. You might think, well, hang on, if they're not protected by Financial Services Compensation Scheme directly, why am I going to put my money with them? Okay, it could be risky. I could lose my cash if they were to go under. Well, what Chip do, and again, some others do this, something like this as well, is the account they offer, they don't actually offer it directly themselves. It's actually, in this instance, via a different bank that is regulated, that is licensed, called ClearBank. So actually, although you're using Chip to deposit your money and to withdraw your money and to look at your balance and things, is actually held in ClearBank. Your account is actually with them and they're protected. So again, as long as it's up to £85,000, you're covered. Now, you have to be careful here, or similar banks do similar things, that you don't also have money either knowingly or unknowingly, because they're doing a similar thing with ClearBank, that in total could take you above 85k. Because it could be you've got 50k in a separate ClearBank account, 50k in Chip. Well, if they went under, if ClearBank went under, you're only protected up to the £85,000. You would lose some money. If Chip was to go under and ClearBank was fine, then your money's held in ClearBank. It's no problem at all. You've still got access to your cash. Others might work a little bit differently, and these are called e-money accounts. What they might do is take your money and hold it in something called in trust with a different bank. And it could be Barclays. It could be another bank you never heard of, but they'll be holding them in trust in a bank that is licensed, is part of the Financial Services Compensation Scheme. So if they were to go bust, the holding bank or the holding app you would put the money with, but they were to go under, your money is still protected up to £85,000 in that account. However, it might take you longer to get that cash. Financial Services Compensation Scheme say this could take maybe a month, maybe 2 months, maybe 3 months to get your money in this way. So again, you've got the protection, but it's worth knowing about if these accounts are holding it, e-money accounts holding it in trust in an underlying bank, it might take a little bit more longer for you to get the money. There are others though, where there is no protection at all. Again, so have a look, find out things, but some big names here, again, you might be surprised about. PayPal. If you have any money sitting in your PayPal account, if something was to happen to PayPal, yes, they've got their own protections, but they are not covered by the Financial Services Compensation Scheme. Similarly, if you have it sitting in a cashback account or in loyalty points or whatever it is, or on a prepaid card, again, these things, they are not protected. So my advice is they're not to keep a lot of money in those kind of forms. Gift cards as well. These are all places that if you lose them or the company goes bust or whatever it is, that cash is gone. There is no protection. The best place for you to put your money is in a financial services compensation scheme protected organization. Now, one thing I do want to talk about, a couple of things actually before we end here. One is there are alternatives to the financial services compensation scheme. In fact, there is an alternative, but you've got a few options there. And this is NSNI, National Savings and Investments. This is a treasury-backed bank. Effectively, it's the government's bank. When you give them money for your savings, you're basically lending it to the government to spend elsewhere, whatever it is. And the return they give you, that comes out of the money they've made from that. So it's government-backed. And that basically means it's really, really safe. And effectively, any money you have in NSNI is protected, even beyond £85,000. So if you do have a temporary balance, which is massive, let's say it's more than £1 million, or potentially you've got it for longer than 6 months, and you don't want to break it all up into lots of different accounts, then NSNI is a good option. Obviously, it depends on the account you've got, exactly what that limit is going to be. Premium bonds, that's part of NSNI. The limit there is £50,000, but you've got a direct saver, which is effectively instant access. That one goes up to £2 million. So, and you can have obviously different accounts there to really increase that if you did have those massive sums. But I do want to end on a thing here, just quickly talking about, yes, if you've got more than 85k, what you can do, how you can spread it around, and where you can get the protection. But the question is really at the end is, do you need £85,000 in savings? Anywhere near that would make you beyond that total, that you could be at risk of your money being kind of lost if something went bust, or even just having that total, even if you got it, knowing it's protected. Because unless there's something that you are actively saving for, deposit on your first home, a car, a wedding, smaller things, holidays, whatever it is like that, if you've got sums for that, and then also enough money to cover core expenses in the event you couldn't work, you couldn't, can't pay the mortgage, can't pay the rent, whatever it is, can't pay your bills, that kind of emergency fund, the amount of those two combined, for most people, is still not going to be anywhere near 85k. It's going to be a lot lower than that. And if you are in that fortunate position to have more money than covering your expenses, maybe cover it for longer if you wish. If you work as a freelancer, sometimes you want more money there to protect you because of that uncertainty. But whatever it is, that and those kind of known expenses you're saving up for, don't have it in cash savings. Broadly speaking, you're going to get a better return on that longer term by putting it into your pension. Plus you get tax relief on your pension, or overpaying your mortgage, or put it in stocks and shares, things like that. It's about diversifying where your money goes. So some stuff in cash is great, but again, having that mix of things is going to be better for you in the longer term. And even though we have seen interest rates on savings improve so much recently, they are still historically not going to perform as well as putting it elsewhere. So again, it's great to tell you about this, how your savings are protected, but I do want to sort of cover that thing about the £85,000. For most of us, it's going to be much more than we ever possibly are going to need. My name is Andy Webb. Thank you so much for watching. Check out these videos here for more ways to make the most from your savings. And don't forget, leave me a comment below, share this video, hit like, hit subscribe. Till next time, cheers.